Merry Christmas and Happy New Year. This is Sherzodbek from CA Business School. So today we'll review the year of 2024 in details by sectors, industries, countries and geographic regions, and at the same time, using the Bloomberg intelligence and analyst opinions, we'll review the 2025 outlook. Let's start to review the 2024 year in more details. A soft landing marked by easing inflation and declining interest rates remains the baseline scenario for major economies. However, while this inflation has been consistent trend throughout the year, recent data reveals inflationary pressures may persist longer than expected. In October, US headline CPI was 2.6%, near pre-pandemic levels, while core CPI reached 3.3%, and the Fed's preferred core PCE hit 2.8%, the highest since April. In Europe, Euro area inflation rose to 2% in October, up from 1.7% in September. In comparison, the rate stood at 2.9% in the same period last year. Progress in disinflation has allowed central banks to adopt a more neutral policy stance following aggressive rate hikes in 2022 and 2023. Throughout the 2024, central banks initiated rate cuts to support economic activity. The S&P led with 3 cuts, reducing its policy rate to 1% with another 25 basis point cut expected in December, which basically happened. The Fed, taking a more cautious approach, started easing in September with a 50 basis point cut, followed by 25 basis points in November and another 25 basis points in December. The ECB also reduced rates 3 times since June, lowering its policy rate to 3.25% by October and another interest rate cut in December, while the Bank of England cut rates twice, setting its benchmark at 4.75%. Unlike other major central banks, the Bank of Japan diverged from the global trend of monetary easing by tightening its policy. In March, the Bank of Japan ended its negative interest rates era with a 10 basis point hike, its first increase in 17 years, followed by another hike to 0.25% in July. These moves aim to support a weakened yen amid concerns about inflation. Speculation of a December hike to 0.5% has recently strengthened the yen, which had previously declined against the dollar. Talking about the US resilience and European struggles. The US economy showed resilience with a healthy 2.8% annualized GDP growth in Q3 and is expected to end up slightly below 3% in 2024, driven by robust consumer spending and increased exports. Advancements in artificial intelligence also contributed to the US economic momentum by enhancing productivity across sectors. In contrast, Europe faced intensified economic headwinds. After a near recession in 2023, economic growth had resumed in early 2024 with a pickup in household consumption and exports. Unfortunately, this encouraging dynamic has rapidly lost momentum. The Eurozone's third quarter GDP showed a modest 0.4% growth, exceeding the 0.2% forecast, and most economic indicators have disappointed expectations. This is due to a succession of adverse developments since 2022, sanctions against Russia following Ukraine's invasion, the ensuing cut from Russian gas supply, weaker Chinese demand for manufactured goods, a surge in inflation, and the subsequent sharp rise in interest rates. These factors have affected Germany most due to the structure of its economy. Meanwhile, France is grappling with political paralysis and budget deficit challenges. Southern Europe economies have been less affected by recent challenges, benefiting from resilient service demand, particularly tourism. In 2024, their growth and economic sentiment have trended positively, a stark reversal from a decade ago when peripheral economies faced deep recessions while core economies drove European growth. The global debt has reached unprecedented levels. It increased by over $12 trillion in the first 3 quarters of 2024, reaching a record of $322.9 trillion. The global debt to GDP ratio fell to 326%, about 30 percentage points below the 2021 record, but remains above pre-pandemic levels. The US budget deficit expanded to $1.8 trillion in fiscal year of 2024, marking the highest level outside the COVID-19 era. Since the end of the debt ceiling crisis in June 2023, total US debt has increased by $4 trillion. In other words, the US has taken on an average of $235 billion in debt per month or $8 billion per day since June 2023. This surge was driven by federal debt interest payments alongside increased spending on social security, healthcare, and the military. In France, the Olympic effect that had supported activity in August has quickly faded away. The country's state budget deficit has ballooned to 173.8 billion euros. After a concerning deterioration of public deficits in the past few years, France has no choice but to draw up an austerity budget for next year that will have to be adopted via special procedure, given the lack of majority in parliament for the government. Far from being a stimulus, fiscal policy will be a headwind for growth in France in 2025. In May, S&P downgraded France's credit rating from AA to AA minus. Late in October, Fitch and Moody's revised France's credit outlook to negative. The yield on France's benchmark sovereign bond, long considered among the safest in the Eurozone, reached the same level as Greece's for the first time in history. Adding to the challenges, the recent resignation of Prime Minister Michel Barnier, following a no-confidence vote, has deepened the French political instability. In China, the government unleashed a bazooka stimulus to stabilize its economy, aiming to address the ongoing real estate crisis and stimulate consumption. Initiatives included permitting local governments to use special bonds for purchasing land from troubled developers and hinting at an upcoming debt ceiling adjustment. While the impact remains to be seen, these policy shifts suggest a potential for recovery in 2025 if fiscal and monetary easing continue. The announcement of these stimulus measures had an immediate positive impact on Chinese equities. The CSI 300 index, which tracks the largest stocks listed in Shanghai and Shenzhen, surged 4.3% on the day of the announcement, marking its best performance since March 2022. However, this initial enthusiasm was short-lived. By the end of the year, the index had relinquished a significant portion of its earlier gains as investors reassessed the effectiveness of the stimulus measures. Argentina's Javier Milei's economic shock therapy is delivering tangible results. When he took office in December 2023, he inherited staggering challenges. Inflation at 230%, the highest in the world, public debt over 60% of GDP, a 200% exchange rate gap, and poverty rate exceeding 40%. Milei introduced bold austerity measures, including spending cuts, bureaucratic reductions, and a peso devaluation. By October 2024, monthly inflation dropped to 2.7%, its lowest in 3 years, and Argentina recorded its first budget surplus in 12 years, which is 1.7% of GDP compared to a 4.6% deficit in late 2023. Sovereign risk measured by the EMBI index improved from 1920 to 984 points. Financial markets responded enthusiastically. The Global X MSCI Argentina ETF increased its assets sevenfold from $104 million to $750 million and delivered a 62.6 year-to-date return, becoming the year's best-performing country ETF. The S&P 500 market value grew by $10 trillion this year. It delivered an exceptional year-to-date return of approximately 28.4%, adding nearly $10 trillion to the index's market capitalization. Market volatility unusually stable, with realized volatility for the S&P 500 averaging just 12.5%. This exceptional performance of the S&P 500 is largely due to the Magnificent Seven, whose gigantic market capitalizations and strong growth have dominated the markets. Apple with 30% year-to-date, Microsoft with 74.8%, Google 26.2%, Amazon 45.5%, Nvidia 201.3%, Meta 77.2%, and Tesla 44.1% year-to-date return lived up to their title in 2024. Without their contribution, S&P 500 return would have been much closer to the average, still respectable but far less remarkable. While everyone was expecting a rematch of Biden versus Trump, it did not happen. For health reasons, Joe Biden was replaced by Kamala Harris as the Democrat candidate. Donald Trump, after surviving 2 assassination attempts, secured a landslide victory and the Republican sweep with the strong support of Elon Musk. Following the election, Trump appointed Musk alongside with Vivek Ramaswamy to have the newly created Department of Government Efficiency, the DOGE, a playful nod to Musk's favorite cryptocurrency, the Dogecoin. This advisory body aims to streamline government operations by reducing bureaucracy, cutting wasteful spending, and restructuring federal agencies. The 2024 US presidential election attracted unprecedented attention and investment, as evidenced by record inflows into betting markets and financial instruments linked to the political outcome. Buying Trump-linked securities such as energy, financial services, defense, and cryptocurrency, and selling Harris-linked ones such as renewable energy, electric vehicles, excluding Tesla, of course, as well as healthcare and infrastructure was a winning strategy in 2024. Talking about gold, chocolate, and coffee, Gold had its best year since 1979, emerging among the best performing assets with a price increase of approximately 30% despite rising real yields and a stronger dollar. This rally was driven by central banks' aggressive buying, strong demand from Asia, and heightened geopolitical tensions. By the end of the year, some profit taking emerged. Silver, the white metal, delivered its own impressive rally. The price surged from $22 per ounce at the start of the year to over $32, marking its first breakthrough of this level since 2012. This strong performance was driven by robust industrial demand, particularly from the renewable energy and electronics sectors, as well as increased investment interest amid geopolitical tensions. Oil prices remained under pressure this year. While rising tensions in the Middle East briefly fueled price volatility early in the year, concerns gradually shifted from potentially supply disruptions to the broader weakness in global demand. Coffee prices surged to nearly 47-year highs, driven by concerns over Brazil's crop yields due to the drought conditions. Cacao and 2024 with an impressive 122% year-to-date performance. The biggest surge came in April when futures peaked at $12,000 per metric ton, a historic high. This spike was driven by severe supply shortages caused by bad weather conditions in producing regions. The cryptocurrencies. Overall, cryptocurrency market capitalization approached $3.8 trillion, nearly doubling over the past year. To the surprise of many, 11 Bitcoin ETFs were approved by the SEC early January. Since launch, they have attracted more than $40 billion net inflows, and their accumulated assets under management are almost as large as those held by gold ETFs. Bitcoin surpassed the $100,000 mark for the first time, up over 132% since the beginning of the year. This surge was largely attributed to the election of President Donald Trump. For the first time ever, the US will have a crypto-friendly White House, as more than 300 congressmen and senators are favorable to digital assets. As institutional adoption and regulation are on the rise, the entire crypto ecosystem is gaining recognition and momentum. Since the beginning of the year, Ethereum has risen by 67%, Solana by 119%, and Ripple has surged by 277%. Additionally, the share price of MicroStrategy Incorporation climbed by approximately 500% year to date thanks to its Bitcoin accumulation strategy. Regarding the financial markets, the US stock market continued to dominate the world in terms of performance in 2024. For a second straight year, American shares led global markets by a wide margin based on a set of exchange-traded funds. US stocks have surged roughly 28% so far in 2024 through December 16th. The strong increase follows last year's robust 26.1% total return. There is also growing concern that US equities are highly valued, and so expected returns are significantly lower relative to the elevated returns that investors have come to expect in recent years. Optimists cite strong earnings and the potential for productivity-enhancing gains from technology, including the artificial intelligence. Nonetheless, the market appears priced for perfection based on the cyclically adjusted price-to-earnings ratio, which is at 38 for the December estimate, close to the highest level in decades. According to Professor Robert Schiller's database, expected returns for the medium to long term are significantly lower compared with recent history. As for the 2024 comparison, American equities outperformed other markets, often dramatically so. The one exception, gold, which is essentially neck and neck with US stocks year to date, otherwise the rest of the field is trailing American equities. Excluding gold, the next best performer after US shares, stocks in emerging markets, which are up 13% so far in 2024. The losers in 2024 are concentrated in various categories of foreign bonds and foreign real estate. Meanwhile, US bonds are on track to post a second year of slight to moderate gains, albeit at a rate that's below the annual pace of inflation. An ETF proxy of US Treasuries is barely above water this year, rising a slight 0.4% year-to-date return. US inflation index Treasuries, the TIPS, are doing better with a 2.6% advance. The big winner in bonds again is below investment-grade bonds, so-called junk bonds, which have rallied more than 8% year-to-date. For securitized real estate, there has been a noticeable divergence between an ongoing rally in US real estate investment trusts and a mild loss in foreign property shares. Commodities overall have rebounded in 2024 with a moderate increase. A rise in crude oil is a key reason, although the 28% jump in gold prices has been the year's big winner in the realm of raw materials. If we review the sectors one by one, the 2024 US election night viewership for Fox News MSNBC and CNN totaled just under 20 million, a 33.6% decline from the 2020's over 30 million viewers. This drop is attributed to a less contentious presidential race and the ongoing trend of cord cutting, reducing pay TV subscribers. Despite the election night decline, major networks experienced double-digit growth in nightly ratings during Q4 of 2024 compared to 2022 and 23, driven by pre-election coverage. Election events still draw significant audiences, but shifting media habits and reduced political tension have dampened overall viewership levels. Fox News remained the leading network, though peaks for all networks were notably lower than in the 2020 cycle. Material sector, some commodity costs could remain elevated well into 2025, with packaged food companies relying on hedging contracts to curb future threats to profitability. If trends continue or worsen due to climate events, margin progression will be tempered, adding to the headwinds in the new year. Hershey expects high levels of cost of goods sold inflation throughout 2025. Commodity hedging contracts typically range from 6 to 18 months. Hedging gives companies the ability to minimize the commodity volatility. Generation Z and millennials overwhelmingly prefer shopping in physical stores despite the rise of online platforms. A striking 73% of respondents favor in-store purchases, with brands like Abercrombie and Fitch's Hollister segment benefiting from this trend, as 70% of its sales occur in physical locations. Discounts remain the most influential factor, driving purchases, with 87% of respondents citing sales as a key reason for buying. Social influence, particularly from friends and platforms like Instagram, TikTok, or YouTube, plays a significant role for Generation Z and millennials, shaping fashion preferences and encouraging purchases. By enhancing in-store experiences, offering competitive discounts, and leveraging social media platforms, retailers can effectively capture the loyalty of these influential consumer groups. Talking about the financial sector, M&T's lending has been stronger than peers, and headwinds in commercial real estate loans look set to dissipate in 2025. Commercials and consumers have contributed to the bank's loan growth, while the CRE has been purposefully reduced due to concentration risks. M&T has said that punitive loss assumptions in the Fed Reserve's annual stress test drove it to seek capital market alternatives to service its CRE customers, which means it has less appetite to keep these loans on the balance sheet. With CRE now only about 22% of the total loans, M&T expects some growth in the category late in 2025. Over the past 4 years, our Wind Peer's share price has been more influenced by the global landscape of permitting issues, elevated interest rates, and supply chain constraints that led to cancelled or delayed projects than by policy, according to our analysis. Despite generous support in the US, wind shares have fared poorly under President Joe Biden's administration, with the median stock in our peer group declining about 11% since January 2021 versus an 80% gain during the Trump administration. By contrast, the broad S&P 500 index gained 50% and the more oil and gas weight S&P 500 energy index jumped 2 times. Talking about the healthcare sector, the CMS's modest 2024 Medicare rate updates relative to inflation in the cost of care add incremental pressure to hospital operations margins. This is considering that most, if not all, of the bottleneck in deferred cares spurred by the pandemic was worked down through 2023, and care utilization among the Medicare cohorts could be paired. The agency's final fiscal 2024 Medicare rate update of 3.1% for inpatient and outpatient settings trails the prior year's gain, but is at the higher end of the updates before the pandemic. Despite the insufficient increase to offset cost of care inflation, the 2024 update appears manageable for large and for-profit focused healthcare systems, a view supported by Q1 results. Talking about the information technology sector, there is a large number of factors to consider when choosing between cooling types. But broadly speaking, transitioning to liquid cooling from air cooling facilities, which carry higher upfront costs, could deliver energy efficiency gains of about 20 to 25%, according to a report by Del Oro. While total data center power consumption can be reduced by 10 to 15%, which could lower a data center's total cost of ownership over a 10-year period by as much as 20 to 40% relative to an air cooling facility. Liquid cooling is expected to take some market share from air cooling by 2028. Yet, air cooling may remain the main cooling solution in 2028 at more than 60% of the data center's thermal management market. Direct liquid cooling requires combination with an air cooling solution supporting air cooling revenue long-term growth. Real estate sector, US net absorption for office space has been consistently negative since the pandemic, and it remains to be seen whether 2025 will be an improvement after another year of weakness in 2024. It is possible that improved absorption trends and occupancy gains can occur in 2025, especially if business-friendly Donald Trump administration is boon for the economy in general. This is especially true for more prime assets where absorption has consistently been better. The CBRE highlights 51 million square feet of positive net absorption in prime buildings since Q1 of 2020 versus negative 168 million for non-prime. Despite weak demand and negative absorption in recent years, asking rents grew, especially for high-quality properties. In some markets where large-cap REITs, the real estate investment trusts, are most prominent, premier office asking rents are about 50% higher. About the materials sector, the Rio Tinto's reported interest in acquiring Orcodium Lithium makes strategic sense and likely serves as a strong signal to lithium producers, including Albemarle, that majors across the materials landscape are keen to invest in the critical battery metal at the bottom of the cycle. It also appears to be an underappreciated catalyst for the downtrodden lithium space, which has grappled with oversupply, depressed prices, and falling valuations. Still, with the robust long-term lithium demand fundamentals intact, conservatively 15% compound annual growth through 2030. About the communication services, the leading US telecom companies have yet to quantify potential cost savings from AI in customer care and network operations. Yet, Deutsche Telekom CEO Tim Hodges said at the company's recent Capital Markets Day that he sees a productivity gain of 20 to 30% in migrating to an AI-driven autonomous network and similar-sized increases in its software development unit and sales and customer service organization. He also sees a 10% improvement in using AI to lower contract analysis and legal costs. Though much of these applications still need to be planned and implemented, there is potential for US carriers to realize significant cost savings by streamlining the operations and automating radio access networks. Information technologies, this year's OCP keynote brought a surprise with Intel and AMD competitors in the x86 central processing unit space announcing the formation of a joint x86 advisory board. We believe this move is an attempt to counter the growing threats from ARM and application-specific integrated circuits, both of which are projected to outpace x86-based architectures in data centers and PCs. In servers, ARM-based entrants like NVIDIA's Grace CPU and custom ARM-based ASIC designs by large cloud providers such as AWS and Microsoft are expected to grow faster. However, the absence of a large-scale merchant ARM-based CPU supply will likely benefit Intel and AMD in the near term. We believe initiatives like this could help slow the market share loss in the sector. S&P 500 Utilities Index lagged behind the broader market by almost 7 percentage points in the first half of 2023, following the 2023's 34-point underperformance. The sector index gained 7.6%, largely fueled by non-regulated independent power producers that benefited from the AI frenzy. Of the 31 members, 22 trailed the index and 10 had negative returns. Looking ahead, regulated utilities probably face more tailwinds than headwinds, given concerns about a slowing economy, rates their defensive appeal, and interest rates likely have peaked. Cheaper valuations, discounts of about 1x to the sector indexes, average 10-year blended forward PE multiple of 17.5x and 5x the S&P 500 index, an estimated EPS growth of over 7% for 2024 to 25, the highest since 2019, also support the group. Now, let's review the 2024 by regions. Talking about Canada, political developments, streamlining legislation. In July, major US streaming services, including Netflix and Disney, petitioned a Canadian court to halt a proposed 5% tax on their sales intended to finance local content and broadcast news. The streaming giants argued that the Canadian Radio, Television and Telecommunications Commission had exceeded its authority, noting their substantial investments in Canada. The proposed tax, expected to generate 200 million Canadian dollars annually, faced criticism for potentially leading to higher prices for Canadian consumers and influencing the streamers to reconsider their presence in the Canadian markets. The Canadian economy demonstrated resilience with real GDP growth in the first quarter of 2024 on track for around 3.5%, supported by higher household and government spending. Inflation remained within the Bank of Canada's target range, standing at 2% in October. In manufacturing sector, December witnessed Canadian manufacturing activity advancing at its fastest rate in nearly 2 years, with the Purchasing Managers Index, the PMI, rising to 52.2 from 52.0 in November, indicating sector expansion. This uptick was driven by U.S. clients stockpiling ahead of potential trade tariffs. The Canadian dollar experienced fluctuations, weakening by 0.2% against the US dollar on the first trading day of 2025, trading at 1.4410 per US dollar. This decline coincided with the US dollar index reaching a 2-year high, driven by expectations of stronger US economic growth. Trade relations. In December, Canada affirmed that the comprehensive and progressive agreement for Trans-Pacific Partnership remains open to new members, including Taiwan. This statement followed by Taiwan's complaint about the lack of a working group to consider its membership. Global Affairs. Canada confirmed that member states would continue to discuss membership requests, emphasizing the inclusivity of the trade pact. Talking about environmental challenges, Canada faced significant environmental challenges, notably widespread wildfires that led to evacuations and air quality concerns. The government implemented measures to address these crises, emphasizing the importance of environmental management and disaster preparedness. About Japan, Prime Minister Fumio Kishida's term as leader of Liberal Democratic Party was set to expire in October 2024. Amid internal party dynamics and public opinion, Kishida sought re-election to continue his administration policies. In July 2024, Tokyo held its gubernatorial election, attracting significant attention due to the city's global prominence and its role as a political and economic hub. Japan's economy demonstrated resilience, with the Cabinet Office estimating a nominal GDP growth of 5.6% in 2023, reaching 593.4 trillion Japanese yen, the strongest growth rate since 1994. The government projected that the economy would achieve a positive output gap in the next fiscal year for the first time in 7 years, indicating that actual economic output would surpass potential output due to a tight labor market. December 2024 saw a contraction in factory activity, though at a slower pace, with PMI index rising to 49.6 from November's 49.0. This marked the sixth consecutive month of decline, influenced by weak demand in domestic and key overseas markets, particularly the semiconductor sector. Bank of Japan Governor Kazuo Ueda indicated the possibility of raising the interest rates if economic improvements persisted, emphasizing the need to assess various risks before finalizing any rate hikes. The BOJ aimed to achieve its 2% inflation target by 2025, having previously raised rates to 0.25 percentage point. Japan witnessed a surge in shareholder activism, with a record number of activist funds acquiring stakes in Tokyo-listed companies. This movement prompted significant corporate change, signaling the end of prolonged stagnation and ushering in an era focused on productivity and profitability. A quick review of India. In May 2024, India conducted its general elections, resulting in Bharatiya Janata Party securing a third consecutive term under Prime Minister Narendra Modi's leadership. The BJP's victory was marked by a significant majority, reflecting continued public support for its policies and governance. Several states, including Maharashtra and West Bengal, held legislative assembly elections. The outcomes varied, with regional parties gaining prominence in certain areas, indicating a dynamic and evolving political landscape at the state level. India's economy demonstrated resilience, with a projected real GDP growth rate between 6.5 and 7% for the fiscal year of 2024-25. This growth trajectory underscores the nation's swift recovery from the pandemic, with real GDP being 20% higher than the pre-COVID levels. The services sector concluded 2024 on a robust note, with the PMI rising to 59.3 in December, indicating the highest activity in 4 months. This expansion was driven by strong demand and robust hiring, contributing significantly to the overall economic performance. The Indian rupee faced depreciation pressures, hitting a record low of 85.84 against the US dollar in early January 2025. Factors contributing to this decline included sluggish economic growth, weak capital flows, and a stronger US dollar. The Reserve Bank of India's interventions provided some support to the currency. About the technological and space achievements, the Indian Space Research Organization, the ISRO, achieved significant milestones, including the successful launch of the Gaganyaan mission, marking India's first crewed spaceflight. This accomplishment positioned India as the fourth nation to independently send humans to space, enhancing its stature in the global space community. Talking about European Union, from June 6th to 9th, over 365 million European citizens participated in the 10th European Parliament elections, a testament to the Union's democratic engagement. These elections were crucial in shaping the EU's political agenda for the 2024-2029 term. Notably, there was a surge in support for right-wing populist parties, reflecting a shift in voter sentiment across member states. In April, the European Parliament approved a comprehensive reform of the EU's migration and asylum policy, aiming to address long-standing challenges related to migration management and solidarity among member states. Additionally, a directive promoting gender balance in corporate boards entered into application at the end of 2024, requiring listed companies to achieve 40% representation of the underrepresented gender among the non-executive directors by June 2026. The European Union faced significant geopolitical challenges, particularly concerning the energy security. On December 31st, Russia reduced gas supplies to Europe via Ukraine, coinciding with the expiration of a 5-year transit agreement. This development underscored the EU's ongoing efforts to diversify energy sources and reduce dependence on Russian gas. Talking about institutional developments, the year also witnessed change in the EU's institutional leadership. Poland assumed the rotating presidency of the Council of European Union on January 1st, 2025, amidst diplomatic tensions and internal challenges. The presidency's commencement was marked by a diplomatic spat with Hungary, highlighting the complexities of intra-EU relations. Talking about Asian countries, the year commenced with general elections on January 7th, leading to the resignation and exile of Prime Minister Sheikh Hasina following mass student protests demanding democratic reforms. This marked a pivotal shift in the nation's political landscapes of Bangladesh. Talking about South Korea, in December, President Yoon Suk-yeol declared a martial law, citing external threats and internal political deadlock. However, this move was swiftly overturned by lawmakers, reaffirming the nation's commitment to democratic governance. In Vietnam, the economy demonstrated robust growth, with the GDP expanding by 7.09% in 2024, a notable increase from 5.05% in 2023. This growth underscores Vietnam's resilience and its strategic economic policies fostering development. In China, the economy grew by approximately 5% in 2024, aligning with the target set by Communist Party. President Xi indicated plans for more aggressive macroeconomic policies and stimulus measures to address deflationary pressures and weak consumer demand in the coming year. In Singapore, the economy grew 4% in 2024, its fastest annual pace since exiting the pandemic, accelerating from an expansion of 1.1% in 2023 and 3.8% in 2022. In Indonesia, the 2024 fiscal deficit was 507.8 trillion rupiah, or 2.29% of GDP, which is smaller than the government's early estimate of 2.7% of GDP. The government must maintain the annual fiscal deficit under 3% by law. Talking about natural disasters and humanitarian responses, several countries, including Nepal, Indonesia, and the Philippines, faced massive floods, resulting in significant loss of life and displacement. These events highlighted the urgent need for effective disaster preparedness and climate resilience strategies. Talking about demographic challenges, East Asian economies, including South Korea, China, and Japan, continue to grapple with record low fertility rates, posing significant concerns for future economic stability and workforce sustainability. About the international relations and diplomacy, beginning its 2-year term as a non-permanent member of the UN Security Council, South Korea played a pivotal role in regional security discussions, particularly concerning the Korean Peninsula. About African countries, several African nations underwent pivotal elections, leading to shifts in governance and the policy directions. These democratic processes underscored the continent's commitment to political participation and representation. Landmark anti-corruption initiatives were implemented across various African countries, aiming to enhance transparency and governance. These measures sought to address systemic challenges and promote economic stability. The World Bank revised its economic growth forecast for sub-Saharan Africa to 3% for 2024, down from an early estimate of 3.4%. This adjustment was primarily due to the civil war in Sudan, which impacted regional economic stability. Despite this, growth remained above the previous year's 2.4%, driven by high private consumption and investment. High debt service costs continued to burden African economies, with debt servicing consuming a significant portion of public revenues. The financial strain hindered investments in critical sectors necessary for sustainable growth. Well, now we're going to review different scenarios expected for 2025. Starting from the scenario number 1, Trump 2.1 with medium probability. Donald Trump's renewed focus on tariff signals a seismic shift that could redefine the global economic landscape, impacting not just the US but every interconnected economy. His sweeping Trump 2.0 vision includes across the board tariffs of 10 to 20% on all imports and staggering 60% on goods from China. But what if concerns over the inflationary effects of tariffs prompt him to pivot, adopting a more conciliatory approach with trading partners, a shift from 2.0 to Trump 2.1? After imposing a new round of tariffs in the early days of his presidency, Donald Trump may engage discussions with China on a broad trade agreement between the world's two largest economies. This time, China is more open to concessions, grappling with weak economic growth and structural challenges like its real estate sector, unlike during Trump's first term in 2017. China has already started to try to rebalance its growth towards domestic demand, and a trade agreement with the US can serve this purpose. China is also better positioned as it had reduced its reliance on US exports. Its trade balance with the rest of the world, excluding the US and Europe, is now equivalent to its trade balance with the US alone. Tariffs are removed on several goods and trade between the US and China increases again. Geopolitical and economic tensions between the US and China eases. Taiwan, intellectual property, role of the US dollar and Chinese yuan in the global financial systems. The EU urged China to negotiate a comparable trade agreement. In the US, easing imported inflationary pressures contribute to a decline in interest rates. China's equity market regains its appeal for US institutional investors, rebounding after a prolonged period of underperformance. Scenario number 2. The US economy faces slugflation with medium probability. The new US administration's immigration policy helps keep unemployment below 4.5% with wages continuing to rise steadily. Meanwhile, China's economy shows signs of an unexpected rebound, driving commodity prices upward and prompting a gradual yet steady recovery in oil prices. Inflation remains stubbornly high, staying well above the Fed Reserve's target. These policy moves and conditions prompt a resurgence in headline inflation, complicating the Fed's plan to cut rates. Prolonged high interest rates begin to weigh on domestic growth in the second half of the year. This slugflation, meaning the sluggish economic growth and sticky inflation, starts to dent US companies' profit margins, sending the S&P 500 into a deep correction territory. A late-year US recession pushes the budget deficit above 10% of GDP. In response to the surge in Treasury issuance, creditors demand higher yields, driving the 10-year Treasury rate to 5.5%. The classic 60 to 40 portfolio faces significant challenges in the year's second half, with both equities and bonds experiencing declines. In Q4, the Fed ends quantitative tightening and briefly restarts quantitative easing, breaking its word of sticking to its inflation target. The third scenario, the Doge goes global with low probability. In January, Elon Musk started to roll out the Department of Government Efficiency measures. Targeting a 25% reduction of the federal government workforce, they decisively put an end to remote work for government employees, triggering a wave of voluntary resignations, similar to Dell's recent stance on remote work. Surprisingly, many governments around the world decide to follow in the steps of US and Argentina. They implement similar measures, leading to spectacular results. The quest for efficiency and spending cuts is not limited to the government. Companies around the world start to implement their internal Doge equivalent, leading to an improvement in firms' productivity and a decrease in bond yields. In Europe, these measures lead to a wave of social unrest. In France, Macron is forced to resign, paving the way for a populist government to take power. Scenario number 4. Germany pushes for fiscal stimulus with low probability. Following the German elections on February 23rd, a CDU-led coalition agrees to relax the constitutional rule limiting public deficits. This opens the door to a much-needed stimulus plan to revive the German economy that has been stagnating since 2022. In this context, Germany also agrees to discuss the issuance of European bonds to finance structural investments designed to improve medium-term growth prospects for Europe, following the recommendations of Mario Draghi's report on the future of European competitiveness. Germany and the Eurozone benefit from this fiscal stimulus, experiencing a boost in growth as Europe joins the US and China in supporting economic activity with public spending. Public debt in Germany starts rising from its current moderate level, and aggregate public debt in the Eurozone increases from an already elevated levels. Inflationary pressures pick up in the Eurozone due to higher domestic demand. With high growth, inflation, and public debt ahead, the ECB faces less pressure to ease its monetary policy and stops its rate cut cycle earlier than expected. European sovereign bonds face pressure as euro yields rise due to stronger growth prospects, increased bond issuance, and higher euro cash rates. Scenario number 5. BRICS Plus adopt Bitcoin as an alternative to the dollar with low probability. Early 2024, the BRICS joined forces to create a unified payment system based on the innovative technologies of digital currencies and blockchain. This ambitious move is not just a technological breakthrough, it also represents a strategic maneuver aimed at strengthening their financial autonomy, reducing their dependence on dominant currencies such as the US dollar, and bypassing traditional banking networks such as SWIFT, which is a source of vulnerability for these nations due to geopolitical tensions. Despite the promising aspects of this initiative, major challenges remain. One key issue is ensuring interoperability between different digital currencies and national payment systems. Additionally, as with any digital financial system, securing transactions and protecting user confidentiality are crucial. After several summits at the start of 2025, the BRICS decide to adopt Bitcoin as an alternative currency to the dollar. Bitcoin ticks all the boxes as a global medium of exchange and reserve currency. It is politically neutral, has an unchangeable monetary policy, ensures strong property rights, and benefits from enhanced functionality through layer 2 solutions like the Lightning Network. Bitcoin is later adopted by other emerging markets. The US, Europe, and China decide to accumulate Bitcoin as a reserve asset, leading to an accelerated adoption by global institutional and private investors. The surge of global demand creates a major supply squeeze, pushing the price of Bitcoin to $500,000. With higher growth, inflation, and public debt ahead, the ECB faces less pressure to ease its monetary policy and stops its rate cut cycle earlier than expected. European sovereign bond face pressure as euro yields rise due to stronger growth prospects, increased bond issuance, and higher euro cash rates. Scenario number 6, from Max 7 to Lag 7 with medium probability. To date, the spotlight has been on the American company NVIDIA, known for its GPUs. These GPUs are key to training massive AI models such as those developed by OpenAI to power technologies like ChatGPT. Although NVIDIA can still export certain chips to China, the US government has demonstrated its determination to restrict its tech competitors' access to advanced semiconductors and the tools needed to produce them. This has intensified attention on China's domestic efforts to develop semiconductor technology capable of challenging NVIDIA and supporting the AI ambitions of the world's second largest economy. One of China's key tech players is Huawei, which has a wide range of businesses, including telecommunications infrastructure, consumer electronics, and cloud computing. Its chip design division, HiSilicon, is currently producing the SN910B chip and preparing to launch the SN910C, which, according to the Wall Street Journal, may rival NVIDIA's H100 products. Earlier this year, NVIDIA's annual report specifically mentioned Huawei as a competitor in AI-focused chip software and networking products. By mid-2025, market sentiment shifts as it becomes evident that NVIDIA is facing significant competition from China. This development triggers a sharp decline in NVIDIA's stock price, mirroring the broader downturn affecting the other Magnificent Seven stocks. Scenario number 7, a US OPEC Plus clash with high probability. The new US Treasury Secretary, Scott Bessent's macro view on what the US economy needs can be summarized with his 3 threes rule. Cut the budgeted deficit to 3% of GDP by 2028, push GDP growth to 3%, and pump out an extra 3 million barrels of oil each day. Under the Biden administration, OPEC Plus was restraining output in a bid to prevent the emergence of a huge supply surplus that could depress prices and hurt the oil-dependent economies of its member states. Meanwhile, US crude production has surpassed every record in history for 6 years in a row, gaining market share at the expense of OPEC Plus. As Besant rolls out his new policy, OPEC Plus decides to counter-attacking by flooding the markets with oil. Consequently, oil may drop to $50 per barrel. Scenario number 8, near zero inflation in Europe, negative rates return in Switzerland with high probability. In 2025, political crisis in France and Germany lead to a paralysis and a major economic downturn. Inflation in the Eurozone approached zero, prompting the European Central Bank to push interest rates well below their natural level. The central bank reintroduces the quantitative easing program to prevent increasing economic fragmentation, exacerbated by political tensions in France and elsewhere. Meanwhile, the Swiss National Bank surprises markets by reintroducing negative interest rates to counter the overvaluation of the Swiss franc, as inflation remains far below target. Despite the proactivity of the SNB, the euro drops to 85 cents against the Swiss franc. Scenario number 9. A major fund blows up with high probability. The combination of concentration risk from the Magnificent Seven stocks, the rise in zero-DTE options, unusually low volatility, and strange movements in currency and commodity markets derails some large fund that is caught in the wrong trades. It will begin with one asset price moving in the wrong direction, triggering a chain reaction in the other trades within the portfolio, leading to forced liquidations and sparking a volatility event. This could come in the form of a flash crash like 2015, a meltdown similar to LTCM in 1998, or a Volmageddon event like in 2018. While these occurrences are rare, the conditions for something similar are in place in fall 2025. Now let's talk about the global macroeconomic trends. Global growth is forecasted at 3.1%, with advanced economies slowing to 1.6% and emerging markets maintaining a resilient 4.3% expansion. Headline global inflation is projected to decline to 3.4% by year end, with advanced economies nearing central bank targets and emerging markets showing mixed progress. Central banks are shifting towards neutral and accommodative stances. The global weighted average policy rate is anticipated to fall to 5%, down from 6.3% in 2024. Now let's have a look at the 2025 outlooks by sectors one by one. Communications sector, the streaming industry is transitioning from prioritizing subscriber growth to focusing on profitability. By 2025, major media companies, excluding Netflix, are expected to post a collective profit of $650 million. This marks a significant recovery compared to a $1.87 billion loss in 2024 and a staggering $6.8 billion loss in 2023. Disney, Paramount, NBC's Peacock, and Warner Bros. Discovery have achieved this turnaround through strategies such as price increases, ad-supported tires, and rationalized content costs. While subscriber growth is cooling across the industry, the emphasis has shifted to improving average revenue per user and long-term cash flow. However, challenges persist as traditional TV continues to face pressure from a rampant cord-cutting and advertisers shifting budgets to digital platforms. This dynamics could drive further consolidation in the media sector. The global internet sector is gearing up for another year of intense capital expenditure as major players including Alphabet, Microsoft, Meta, Amazon, and Oracle are significantly increasing investments in AI and large language models. Hyperscalers are projected to increase capex by 25 to 30% in 2025, following a more than 50% jump in 2024. These investments are aimed at scaling AI services like chatbots, copilots, and other generative AI tools, which are in the early stage of monetization but holds long-term growth potential. Meta continues to lead high spending trends with its reality labs segment, projecting losses of $18 to $20 billion in 2025 due to slow adoption of its AR/VR offerings. Despite these, investments in AI-related infrastructure remain a key focus as companies aim to boost engagement and ad targeting capabilities. However, challenges persist. Tougher sales comparisons for digital ad vendors, pressure on online marketplace take rates from AI agents, and slower adoption of subscription-based services. The broader internet sector faces mixed margins in 2025, while higher depreciation expenses could weigh on free cash flow. Productivity gains from generative AI deployments and reduced hiring may partially offset these pressures. As hyperscalers prioritize AI development, monetization of these technologies will be crucial to unlocking sustained top-line growth. US telecommunications sector is focusing on broadband expansion to address slowing growth in mobile and wireline services. Wireless service revenue for Verizon, AT&T, and T-Mobile is expected to grow by 3.5% in 2025, supported by ARPU gains, but hindered by declining postpaid net additions and rising competition from cable operators. Cable operators like Comcast, Charter, and Altice USA are projected to capture 32.6% of postpaid net additions by 2025, leveraging competitively priced wireless broadband bundles starting at $25 per line. Cable subscriber share is expected to rise to 5.3%, intensifying competition and limiting carriers' pricing flexibility. Declining legacy wireline services are offset by robust demand for fiber and fixed wireless broadband. Wireless operators' subscriber share will drop from 96.1% in 2023 to 94.7% in 2025, while cable will grow to 5.3%. Cable captured 32.9% of postpaid net additions in 2024. About the consumer discretionary, the global e-commerce is set for growth in 2025, with US online retail sales projected to rise 9%, led by Amazon and improvements from generative AI. In EMEA, Zalando, Allegro, and Next are driving sales growth with leaner into inventories and better margins. Asia's growth is spearheaded by Alibaba, PDD, and JD.com, with Temu and Shein expanding in Japan and Southeast Asia. Generative AI, inventory efficiency, and tech investments are driving growth. Competitive pressures are rising, especially from Shein and Temu. Regarding the regional highlights, Zalando cuts inventory, boosts margins. Next, growth with price hikes and marketing. Amazon dominates, supported by AI-driven conversions. Alibaba and PDD face tariff headwinds but remain growth leaders. EV to EBITDA multiples, which is enterprise value to earnings before interest and tax, depreciation, amortization, for European e-tailers remain at historic lows, while valuation concerns weigh on Japan's Rakuten due to restructuring delays. The North American auto sector is expected to face volatility in 2025, driven by weak economic growth, high unemployment, and inflation. Bloomberg Economics forecasts U.S. auto sales declining from 16.5 million to 15.5 million in 2025, aligned with Bloomberg Intelligence's projections. Tariffs risks under the Trump administration could disrupt supply chains, while relaxed self-driving regulations may benefit Tesla and the autonomous vehicle industry. The key trends: automakers are prioritizing cost-efficient BEV production though Ford scaled back its EV push after $5 billion loss. Inventory challenges remain, with Nissan and Hyundai leading dealer stock among the Asian brands and GM outperforming Detroit peers. Despite uncertainties, the sector's focus will be on navigating policy risks and optimizing EV strategies amid weakening demand. The consumer staples. The retail sector faces cautious consumer spending, with focus on essentials driving smaller basket sizes. Retailers like Walmart, Kroger, and Dollar General must boost store traffic and sales volumes through promotions, private label strategies, and investments in omnichannel technology. Retail media network spending is set to grow at a 24.1% cumulative average growth rate, reaching $129.93 billion by 2028, fueled by first-party data reliance and integrated digital in-store shopping trends. Key trends: persistently high prices prioritize essentials. Food at home inflation was 1.1% in October versus 3.8% for food away from home. Retailers leverage RMN and AI for targeted ads and promotions to boost market share. They also aim for modest margin expansion through cost-cutting, private label growth, and operational efficiency. Retailers must adapt to shifting consumer behaviors while navigating economic headwinds like higher waste and inflation. Packaged food companies face increasing competition from private labels as retailers enhance offerings and quality. Kraft Heinz and Conagra are most exposed, with private label penetration at 22% in condiments and 20.1% in dairy. A strong brand equity has helped Hershey and WK Kellogg retain market share. Private labels led by Walmart, 86% household penetration, continue to grow. Innovation and marketing are critical for packaged food brands to defend share, and weak demand and potential tariffs may pressure margins, limiting large M&A deals. Also, packaged foods players must focus on efficiency and product differentiation to sustain growth. Global beauty, home, and personal care sector is positioned for balanced volume and price growth in 2025, despite consumption challenges in the US and China. Leading companies like Procter & Gamble, L'Oreal, and Colgate are expected to reinvest margin gains from lower input inflation and productivity improvements. Laundry products are projected to grow, supported by new launches from Procter & Gamble and Church & Dwight. Fragrances show volume growth 8% due to moderated price hikes, but cosmetics and skincare continue to decline. Haleon and Procter & Gamble may lead organic growth with trusted remedies aided by increased ad spending to reinforce premium brand value and limit trading down to budget options like e.l.f. Cosmetics. Consumer sentiment and easier comparables may lift essential goods volumes, but discretionary categories face pressure. In China, retail sales recovery depends on stimulus-driven sentiment improvements, with consumer spending lagging despite policy support. Cautious capital expenditure and increased focus on innovation and ad spending will be key to navigating challenges and sustaining growth. The energy sector in 2025, the Asia-Pacific oil and gas producers face a volatile 2025 amidst weakening demand, geopolitical uncertainty, and potential supply surges. China's fuel exports fell 7.1% year-over-year in 2024, worsening its domestic glut and pressuring refiners' margins. Diesel cracks in Asia have plunged 45.8% to $12.32 barrel since January, driven by weaker regional demand and rising Russian exports. China's manufacturing PMI remains in contraction, signaling soft oil product demand. US-China trade dynamics, OPEC plus policy change, and potential US shale oil's resurgence under Trump could disrupt the markets. Expected to hover around $70 per barrel in 2025 before a potential recovery, oil prices are expected to be volatile and stagnant. Producers must navigate these uncertainties while addressing fluctuating margins and balancing supply-demand dynamics. The global solar capacity is set to grow by over 20% in 2025, continuing its position as the fastest growing energy subsegment. After a 30% drop in the module prices and raw industry-wide sales decline in 2024, a rebound is likely, driven by robust demand and glowing price declines. Global solar sales could surpass $200 billion in 2025, with US-listed peers like First Solar, Enphase, and other similar companies. US natural gas producers are positioned for improvement in 2025, with Henry Hub prices stabilizing above $3.5 per million BTU amid tighter winter balances and growing demand. Cooler temperatures and higher heating degree days are driving consumption, offsetting production stabilization at key basins like Appalachian and High Nashville. Sub $2 prices appear unsustainable, supported by lower daily production compared to last winter. Winter withdrawals and rising natural gas exports tighten balances, while pipeline expansion improve takeaway capacity in Appalachia and the Permian. E&Ps benefit from synergies, free cash flows yields, and the demand from the technology sector, despite civic resistance to traditional energy sources. Natural gas exports and domestic power generation demand are expected to underpin steady growth and financial flexibility for producers in 2025. About the financials, global investment banks' sentiment has rebounded in 2024, supported by expanding valuation multiples and recovering revenue. Stock prices gained a median 8.7% in recent months, while EPS estimates for 2024 and 2025 increased modestly by 0.7 to 1%. Blended forward PE multiples rose to 10.5x, reaching levels last seen in early 2021. Price to tangible book value ratios also improved, with Barclays and Nomura leading gains, while UBS lagged due to integration challenges with Credit Suisse. Talking about the top performance, JP Morgan maintains high returns, expected to stay above its 17% ROTE targets for 2024, driven by robust net interest income and market share growth. Morgan Stanley positioned for profitability growth via wealth management and leaner staffing, despite a slightly lower margin outlook under its new CEO. Bank of America, solid profitability, but remains weighed down by softer lending and unrealized securities losses. About the underperformers, UBS faces execution risk from Credit Suisse integration, limiting near-term capital returns and profitability improvement. Citigroup continues to grapple with regulatory scrutiny, with valuations at the low end of the peers. The revenue dynamics, Goldman Sachs leads peers in trading revenue exposure with over 65% of revenue from trading and advisory. Jefferies is also highly reliant on underwriting and fees, positioning both for gains and as activity recovers. Recovering underwriting and advisory fees are boosting top-line growth, with Goldman Sachs reporting a significant pipeline increase in the second quarter of 2024. The sector trends and risks compensation costs remain elevated, with banks anticipating a recovery in fees. Operating leverage is improving for capital markets-focused players like Goldman and Morgan Stanley. Economic uncertainty and potential increases in credit provisions could pressure profitability in the quarters ahead, especially for traditional lenders like Bank of America and Wells Fargo. UBS's Credit Suisse integration introduces capital return limitations, while legal costs weigh on Deutsche Bank and Citigroup. UBS delivered the strongest stock performance among the global banks in 2023, aided by its Credit Suisse acquisition and leading payout ratio despite integration risks. Barclays posted peer-leading gains of 52% in 2024, reversing its underperformance from 2023. Nomura also excelled with a 41% gain, supported by Japanese equities outperforming. So for 2025, we expect trading revenue to remain resilient, supported by recovering markets-driven activity. Compensation adjustments and non-pay cost controls could aid margins, especially for capital markets banks. However, economic risk and evolving regulatory requirements remain key uncertainties. About the healthcare, the medtech industry is set to sustain momentum in 2025, driven by innovation in robotics, pulsed field ablation, and diabetes management. Large players such as Abbott, Boston Scientific, and Medtronic are poised for organic growth above historical averages, supported by new product launches and operating margin expansion. Despite underperforming broader markets in 2024, the sector benefits from robust procedure volumes and an aging demographic, creating strong demand for advanced treatments. Talking about the key trends, companies like Medtronic and Procept Biorobotics are launching cutting-edge devices expected to drive double-digit growth. Robotics adoption for surgical procedures remains a major growth driver. The S&P 500 Healthcare Equipment Index rose 15.6% year-to-date, trailing the S&P 500's 29.2%. The medtech sector's PE multiple, which is 25.3x, remains above its 10-year average despite sector underperformance, reflecting its robust pipeline and steady demand. About the growth drivers, Boston Scientific's pulse field ablation technology captured a cardiac ablation market share. Procept Biorobotics Hydro system shows positive momentum in the US and Europe. Aging demographics are increasing demand for cardiovascular and diabetes treatments. About the opportunities and challenges, Medtronic aims for FDA approval of its robotic Hugo system, while Boston Scientific and Abbott target leadership in electrophysiology and cardiovascular therapies. Regulatory hurdles and competition remain, with Dexcom and Teleflex underperforming in 2024 due to sales force disruptions and product pressures. For 2025, EPS for the S&P 500 Healthcare Equipment Index is projected to expand 9% year-over-year, potentially reaching double-digit growth if volume trends follow conservative estimates from 2024. Companies like Abbott, Boston Scientific, and ResMed are expected to lead EPS growth due to organic sales expansion and operating leverage. The medtech sector is poised to outperform in 2025, supported by systematic innovation and robust procedure demand, despite potential policy change under a new U.S. administration. Regarding the revenue and margin growth, large-cap industrials are projected to grow revenue by 4 to 5% in 2025, an improvement from 2 to 3% in 2024 due to easier comparisons. Operating margins are expected to expand by 70 basis points compared to 90 basis points in 2024, reflecting ongoing cost management and price adjustments. But the tailwinds driving growth, federal initiatives including the Inflation Reduction Act and the CHIPS Act are fueling investments in renewable energy, semiconductors, and infrastructure. The IRA tax credits worth $369 billion could leverage over $1 trillion in private spending over the next decade. Mega projects in data centers, EV capacity, and grid infrastructure are key contributors, with institutional construction projected to grow 4% after an 11% jump in 2024. Aerospace and defense sectors, supported by public and private funding, are positioned for strong performance. Yet challenges remain in 2025. Tariffs remain a risk, potentially adding cost pressures that could impact profit margins. Cyclical end markets like construction and agriculture equipment face tepid demand. Broader industrial production remains weak, with the US PMI at 48 as of November, signaling contraction. Regarding the market performance and valuations, large cap industrials gained 23% year to date, trailing the S&P 500's 27%, with cyclical stocks dragging performance. The sector's forward EV over EBITDA multiple is 17.8x from the 16.8x in 2023, representing a 19% premium to the S&P 500. Machinery peers trade at a lower 8.9 times EV over EBITDA, a 50% discount to large cap industrials due to weaker cyclical demand. Free cash flow for large cap industrials is expected to expand by 19%, driven by normalizing working capital and easing supply constraints. Companies like Honeywell, Korea, and Fortive are expected to focus on bolt-on M&A and share buybacks, with deal activity projected to remain strong. The median EV over EBITDA multiple for industrial deals stands at 16.7x, slightly below the 2022-23 average of 17.8x. Sector-specific updates, electrification and AI trends are driving strong demand in HVAC and electrical equipment, with Train and Amphenol benefiting from data center investments. Second, data center construction is expected to grow 6% annually throughout 2027, offsetting softness in commercial office construction. Companies like Honeywell and Parker Hannifin may outperform, with sustained demand from defense projects and aerospace mega projects. Consumer-facing industrials like Rockwell Automation remain pressured, with cyclical demand lagging. Now let's turn to materials sector. European steel demand is expected to rebound 1 to 2% in 2025, following a 2 to 3% decline in 2024. Restocking and improved monetary conditions could boost apparent demand by 8 to 9%, lifting utilization rates above 73%. The hot-rolled coil (HRC) steel prices could recover to 650 to 680 euros per ton by mid-2025. Margins may improve in the second half of 2025 as demand rises. The sector's EBITDA could increase by 11% year over year, following a 25% drop in 2024. Under a strong recovery scenario, sector-wide EBITDA could grow 18% to 12.5 billion euros. Challenges remain. Steel imports up 6% year to date in 2024 are expected to pressure domestic producers further in the first half of 2025. Uncertainty around tariffs and weak automotive demand will weigh on recovery. Steelmakers are trading at an EV to EBITDA multiple of 3.8x, one standard deviation below their 10-year average of 5.4. About the key companies, ArcelorMittal is positioned to benefit most, with strong exposure to spot prices and diversification in high growth regions. ThyssenKrupp and Salzgitter may underperform due to structural weaknesses in Germany. Now, the global copper market, Ivanos Kamoa-Kakula mine is projected to produce 600,000 tons of copper in 2026, making it the third largest copper mine globally. Backup power installations have increased capacity to 145 megawatts, reducing risks from grid instability, but still insufficient for larger facilities. Kamoa's smelter, Africa's largest company, will begin operations in the first quarter of 2025 with a 500,000 ton capacity, cutting logistics costs by $440 to $570 dollars per ton. This move is expected to lower cash costs by 20 to 26 cents per pound, significantly improving margins. Copper prices are forecasted to range between $9,750 and $9,850 per ton in 2025-26, with potential spikes up to $15,000 per ton due to tightening supply. The global copper market is set to face supply growth stagnation by 2026, with demand driven by electrification and renewables. Ivanos Kipushi zinc mine aims to reach production of 270,000 tons annually by 2026, but faces delays due to operational challenges. The Platreef project will start in the second half of 2025, producing 400,000 ounces of platinum group metals and gold, with future expansions planned. Talking about real estate for 2025, US office net absorption has been negative since the pandemic, but 2025 may see an improvement if economic policies under a business-friendly administration stimulate demand. High-quality office buildings outperformed with 51 million square feet positive net absorption in prime properties since the first quarter of 2020, compared to 168 million square feet in non-prime assets. Prime asset vacancy rates are 15.5%, and asking rents for premium office properties are 50% higher than the non-prime spaces in many key urban markets. Urban REITs like BXP and SL Green are expected to benefit the most from occupancy gains in 2025, recovering from a 700 basis points drop since 2019. Lower interest rates anticipated through 2025 should support asset values and ease refinancing pressures. Forecasts suggest 2 rate cuts and 10-year treasury yield above 4%. From the technology sector, tech firms are returning to the leasing market in cities like New York and San Francisco, with NYC alone seeing active search for over 6 million square feet of office space in late 2024, nearly double year over year. The European commercial real estate political uncertainty in France, Germany, and the UK may dampen retail REIT performance. UK taxes taking effect in April could increase costs for REIT tenants, risking 3 to 6% net tangible asset growth for REITs like Klépierre, Lansac, and British Land. Mall rents grew 4% year over year in the third quarter of 2024 for Klépierre, but face risks from consumer confidence declines in France and Germany. Retail REIT loan-to-value ratios, LTV ratios, are below 60% covenants, and interest rate coverage averages a healthy 4.6 times across peers. However, share prices remain 13 to 27% below the NTA for Klépierre and Hammerson, respectively. Prime commercial properties with higher occupancies and yields have better prospects in 2025. Yield spreads for prime malls are at 300 to 400 basis points in continental Europe, supporting valuation stability. M&A appetite remains low due to higher capital costs, with companies like URW focusing on divesting U.S. assets and developing mixed-use projects. Key takeaways for 2025: recovery is uneven, with prime assets outperforming due to better tenant demand and higher rents. Interest rates cuts could improve refinancing conditions. In retail real estate, growth depends on consumer confidence, stable valuation, and political clarity. Tax change and rising costs pose risks to tenant stability. M&A trends expansion will likely focus on selective acquisitions or redevelopments funded by asset sales. Now let's turn to technology sector. AI server demand is projected to grow 55% in 2025, following 162% growth in 2024, driven by NVIDIA's Blackwell GPUs. The custom AI silicon market is expected to expand at a 24% average growth rate in unit terms, with major beneficiaries like Broadcom and Marvell leveraging their connectivity solutions. About 96% of semiconductor companies are forecast to report year-over-year revenue growth, compared to 44% in 2024. Wafer fabrication equipment sales could rise 6% to $112 billion in 2025, with a possible range of -16% to +26% depending on the market conditions. Talking about the key companies, NVIDIA maintains a 95% GPU market share with incremental competition from AMD. ASML dominates the EUV lithography markets with 100% market share, critical for advanced chip making. TSM positioned to grow faster than peers, benefiting from expanding capacity and AI-related demand. Talking specifically about the hardware and EMSs, AI server deployment will lead to the first inventory build-up cycle since the pandemic, with EMS ODM inventory days dropping from 51 to below 50 days. EMS ODM revenue is projected to rise 20% in the first half of 2025 after a 4% decline in 2024. Companies like Honhai, Quanta, and Winstron will see strong demand as AI server shipments increase. Yet, challenges remain. Sluggish demand in PCs and smartphones, particularly global PC shipment growth, is expected to stay around 2%, while smartphone shipments may grow by 2.3% in 2025. EV component growth faces headwinds, with EV shipments outside China expected to remain below 10% growth. About the cloud and AI, global server market revenue is forecast to grow 31% in 2025, with AI servers contributing to the majority. NVIDIA's Blackwell GPUs will power large-scale AI clusters with custom silicon from hyperscalers like Amazon and Google, broadening market dynamics. AI-related capital expenditures by hyperscalers are projected to rise 19% year over year. Yet, opportunities remain solid. Normalized inventories and recovering cyclical markets in PCs and smartphones, sustained investments in AI-driven innovation with advanced chip-making tools gaining traction. Risks related to U.S.-China trade tensions. Export restrictions could reduce tool shipments to China by 30 to 40% for companies like ASML and Tokyo Electron. The macroeconomic factors, persistently high interest rates, could constrain valuation and investments. Now let's turn to utilities sector. North American utilities earnings growth. The S&P 500 utilities anticipate EPS growth of 5 to 22%, driven by record capital expenses supported by tax credits from the Inflation Reduction Act. Elevated bond yields and customer affordability concerns could limit expansion opportunities. Xcel Energy faces liabilities exceeding $215 million related to Texas and Colorado wildfires, highlighting the financial risk of climate-related disasters. About the European energy transition, power grids and gas networks, electrification policies favor power utilities like Elia over gas-focused peers like Engie, aligning with long-term decarbonization goals. About the gas prices, a potential rebound of over 30% due to tighter LNG markets could temporarily bolster earnings for utilities with gas trading portfolios. Green hydrogen challenges remain. Limited regulatory support and high costs hinder green hydrogen adoption, casting doubt on ambitious production targets. Utilities are pivoting towards renewable energy, grid modernization, and battery storage. Notably, NextEra is set to secure over $1 billion annually from IRA tax credits for renewables and nuclear. Regional and country-specific outlooks for 2025, starting from Northern American region, the United States. In 2024, the U.S. economy experienced moderate growth of 2.1%, supported by strong consumer spending despite tightening credit conditions. However, investment activity slowed due to higher borrowing costs and geopolitical uncertainties. For 2025, GDP growth is projected to moderate to 1.8%, reflecting a cooling labor market and slower industrial expansion. Inflation is expected to ease to 2.5%, supported by declining energy prices and decelerating wage growth. Fiscal challenges remain critical, with the Fed deficit surpassing 7% of GDP, potentially limiting fiscal policy flexibility. The Federal Reserve's measured rate cuts will aim to sustain economic momentum without reigniting inflationary pressures. The 2024 presidential election saw the return of Donald Trump to office, bringing a renewed focus on protectionist trade policies, deregulation, and tax cuts aimed at stimulating domestic industries. Trump's administration is expected to prioritize renegotiations of trade deals, particularly with China, and implements stricter immigration controls. Congressional dynamics will significantly influence the passage of his proposed tax reforms and infrastructure spending. Trump's America First agenda emphasizes reshoring manufacturing and reducing dependency on Chinese imports. Anticipated tariff increases on electronics and steel could strain global supply chains but support domestic production. Labor markets are expected to face tighter controls on immigration, which could exacerbate shortages in key sectors like agriculture and construction. However, efforts to expand vocational training programs aim to offset these challenges. Sectoral analysis, starting from manufacturing, the sector will grow modestly in 2025, supported by increased demand for semiconductors and electric vehicles. Automation is expected to reduce costs and improve productivity, particularly in high-tech industries. However, rising trade tensions with China could limit access to critical raw materials. Examples include Intel's investments in domestic chip production and Tesla's expanded EV output. Talking about the services, healthcare and IT will lead service sector growth, with telehealth usage projected to increase by 20% as remote care infrastructure matures. Cloud computing and AI integration will dominate IT service growth, exemplified by Amazon Web Services and Google's cloud expansion plans. In agriculture, rising global demand for U.S. agricultural products will drive exports, particularly soybeans and corn. However, climate-related disruptions such as droughts could impact yields. Precision agriculture technologies like John Deere's AI-enabled tractors will mitigate some risks and improve efficiency. Canada saw steady GDP growth of 2.0% in 2024, driven by robust energy exports and resilient services sector. However, rising household debt levels and a cooling housing market have begun to temper domestic demand. For 2025, growth is forecast to slow slightly to 1.7%, supported by infrastructure investments and increased trade with Europe under the Comprehensive Economic and Trade Agreement. Inflation is expected to stabilize at 2%, while the Bank of Canada's accommodative stance will underpin financial stability. Prime Minister Justin Trudeau's re-election in 2024 solidified his focus on progressive policies, including climate change mitigation and trade diversification. His administration is expected to prioritize indigenous reconciliation and investments in green technology. With the US adopting a more protectionist stance, Canada will focus on strengthening trade relationships with Europe and Asia. The Comprehensive Economic and Trade Agreement is poised to deliver robust growth in agricultural and energy exports. Housing affordability initiatives and investments in renewable energy projects will address socioeconomic inequalities, while immigration policies are expected to support labor market growth. About the sectoral analysis, investments in EV production and battery technologies will drive growth, particularly in Ontario and Quebec. Companies like Magna International are expected to benefit from new trade agreements with the European Union. The financial services sector is forecast to grow 3%, with fintech innovations and blockchain adoption leading the way. Tourism will rebound with a 10% increase in international arrivals, particularly from Europe. Strong global demand for wheat and canola will boost exports, though logistical bottlenecks may persist. The adoption of climate-resilient crops is expected to rise by another 15%. Now let's talk about the European region. The Eurozone expanded by 1.4% in 2024, but regional disparities persisted, with southern economies lagging behind. Weak industrial activity in Germany and fiscal tightening in southern member states have concentrated growth. In 2025, GDP growth is projected to slow to 1.2%. The European Central Bank is expected to continue rate cuts, supported by declining inflation, forecast to fall below 2%. However, high public debt levels and sluggish productivity remain structural challenges. The 2024 European Parliament elections saw gains for Green and populist parties, reflecting growing polarization. The Eurozone will leverage its leadership in renewable technologies to expand exports to emerging markets. However, disruptions from the Ukraine conflict will continue to affect energy supply chains and trade flows. High youth unemployment in southern member states remains a pressing challenge, prompting renewed efforts to invest in vocational training and digital literacy. While reviewing the sectoral analysis, green technology investments such as wind turbine production in Germany and Spain will offset declines in traditional manufacturing. The sector is forecast to grow by 1.5%. Fintech and digital banking services are set to expand, supported by the ECB's Digital Euro initiative. Tourism will recover to pre-pandemic levels with a 12% increase in Mediterranean destinations. Precision farming techniques are expected to increase yields by 8%. Subsidies for organic farming will encourage a shift towards sustainable practices, especially in France and Italy. In the UK, after growing by 1.2% in 2024, the British economy is expected to decelerate to 1% in 2025. Persistent Brexit-related trade frictions combined with fiscal tightening are key drags on economic growth. Inflation, while moderating, is expected to remain above the Bank of England's target at 2.3%. Fiscal consolidation measures are anticipated to limit public investment, while labor shortages in agriculture and healthcare continue to pose challenges. The 2024 general election brought Starmer to power with a focus on repairing post-Brexit trade relationships and enhancing public services. His administration aims to restore confidence in the UK's economic strategy by pursuing pragmatic trade policies and addressing labor shortages. The UK is expected to expand trade agreements with Asia-Pacific nations and strengthen ties with the US. Efforts to improve agricultural and digital service exports will be central to growth. Policies to tackle workforce gaps in agriculture, healthcare, and manufacturing will include immigration reforms and targeted vocational training programs. From the sectorial perspective, growth will remain subdued at 0.8%, with potential gains in defense and aerospace sectors driven by increased government spending. Rolls-Royce's small modular nuclear reactor program highlights innovation opportunities. The financial sector will grow modestly, benefiting from trade deals with Asian markets. Legal and consulting services are expected to expand by 2%, driven by demand for Brexit-related advisory work. Automation and robotics will address labor shortages, with a forecasted 10% increase in productivity in agriculture. Exports of premium products such as Scottish whisky will grow 5%. Germany's economy expanded at 0.9% in 2024, constrained by weak global demand and supply chain disruptions. For 2025, GDP growth is forecast at 0.8%, with inflation stabilizing at 1.8%. Industrial output is expected to remain weak, though targeted investments in green energy and EV infrastructure could provide medium-term support. Fiscal policies will focus on supporting digital transformation and reducing energy dependency on external suppliers. Olaf Scholz's coalition government faced mounting challenges throughout 2024, culminating in its collapse by year-end due to internal disagreements on defense spending and energy transition policies. As Germany prepares for new elections in early 2025, interim leadership will focus on maintaining economic stability. Political uncertainty could delay major policy decisions, but the green energy transition and support for Ukraine remain central issue. Germany's industrial base will benefit from expanded trade agreements with Asian markets, particularly in automotive and machinery sectors. Exports of green technologies, including wind turbines and electric vehicles, are expected to grow as global demand for sustainability rises. Germany faces challenges from an aging population and labor shortages in key industries. Investments in vocational training and automation will address workforce gaps, while policies to integrate migrants into the labor market will remain critical. Germany's focus on renewable energy and EV production will lead to a 2% growth in these sectors. Companies like Volkswagen are pivoting towards EVs supported by EU green policies. Engineering and consulting services will benefit from global infrastructure projects growing at 3%. Logistics services are poised for a 4% increase driven by e-commerce. Precision farming and government subsidies will improve efficiency, with dairy and cereal exports forecast to rise by 7%. Talking about the Asian region, in 2024, China's economy grew by 4.8%, driven by strong domestic consumption and government infrastructure spending, but faced headwinds from sluggish export demand and real estate sector challenges. For 2025, growth is expected to moderate to 4.5%, with inflation remaining low at 1.45%. Policy measures aimed at boosting private investment and stabilizing the housing market will be critical, though ongoing US-China trade tensions may hinder export recovery. President Xi continued leadership following the 2024 National People's Congress ensures policy stability, with a focus on economic self-reliance and regional influence through the Belt and Road Initiative. Reforms targeting local government debt and state-owned enterprises will shape the economic landscape, though tensions with the US will persist, but China will deepen economic ties with emerging markets in Asia, Africa, and Latin America. Trade volumes with Europe are expected to grow, driven by renewable energy and technology exports. Urbanization and investments in affordable housing will drive social mobility, but income inequality remains a key concern here. Doing the sectoral analysis, advanced manufacturing in EVs and semiconductors will drive 5% growth. Companies like BYD are expanding their global footprint, capitalizing on rising EV demand. E-commerce growth will accelerate by 15%, supported by rural digitization efforts. Alibaba and JD.com are expected to lead this expansion. On the other hand, investments in food security and modernized supply chains will boost productivity by 4% in agriculture, particularly in rice and pork production. India led global growth in 2024 with a robust expansion of 6.6%, supported by infrastructure investments, robust domestic demand, and export growth in pharmaceuticals and technology. In 2025, GDP growth is expected to sustain momentum at 6.4%, driven by continued investment in renewable energy and manufacturing. Inflation is anticipated to moderate to 5.5%, enabling the Reserve Bank of India to maintain a balanced monetary policy stance. Prime Minister Modi's re-election in 2024 reinforced his mandate for economic reforms and infrastructure development. Policies will focus on digital inclusion, manufacturing expansion, and energy security. India's emphasis on trade agreements with Africa, Southeast Asia, and Middle East will enhance export growth in pharmaceuticals, IT services, and textiles. Urbanization trends and financial inclusion initiatives will boost domestic consumption, though regional disparities will require attention. Sectoral analysis: growth in pharmaceuticals and electronics manufacturing is forecast at 7% growth. Initiatives like Make in India and investments from companies such as Foxconn will enhance exports. IT and digital services will grow by 8%, driven by global demand for outsourcing and software development. Examples include the TCS and Infosys expanding AI capabilities. Government-led irrigation projects and adoption of advanced farming techniques will increase output by 6%. Japan recorded modest GDP growth of 1.1% in 2024, supported by fiscal stimulus and rising exports of advanced technologies. In 2025, growth is projected at 1%, with inflation aligning with the Bank of Japan's target rate of 2%. Structural reforms to address labor shortages and improve productivity, alongside investments in robotics and green technologies, will underpin the economic performance. The Prime Minister retained power in 2024 with priorities on defense modernization and technological leadership. Collaboration with Indo-Pacific allies will strengthen Japan's geopolitical standing. Japan will see rising demand for its robotics and green technologies, driven by Southeast Asian and European markets. Strategic partnerships will enhance trade competitiveness. Aging population will prompt increased automation in elder care and investments in healthcare infrastructure. Robotics and automation will drive 4% growth in high-tech manufacturing. Companies like Fanuc are expanding operations globally. Healthcare services will grow by 3%, supported by aging population and increased healthcare facilities. Premium exports such as Wagyu beef and sake will grow by 10%, supported by government branding initiatives. As we close the chapter on 2024, we have witnessed a year of innovation, resilience, and transformation. From groundbreaking advancements in technology to the shifting tides of global economies, the events of this year have set the stage for what's to come. But 2025 is not just another year, it's a defining moment. It's a time for bold ideas, decisive action, and unyielding collaboration. The challenges ahead are great, but so are the opportunities. Together we can navigate this rapidly changing world and shape a future of progress, prosperity, and purpose. This is Sherzodbek from CA Business School. Thank you very much for your attention. See you in other rubrics.